Hello guys, welcome back to my YouTube channel, it's Castaway Trader. And today we will be talking about an easy way to trade with the trend. You've heard many times that every trader should try to trade with the trend, not to play against the trend. Let me tell you this, I've been trading for more than 23 years. I started to trade in 1997 and it's easy to say, but it's not that easy to do. But it seems like I found the way how to simplify that. Before we start, I need you to read that important disclaimer. This is page number 1 and page number 2. Again, this is how my website looks like. It is located at www.castawaytrader.com. This is where you can find information about my video courses. Just look at education section. You can check out some free updates, and in the section updates, I post analysis and charts only available for my subscribers. If you click subscribe, you will see how you can become a subscriber of my service. I post a lot on Twitter and my account is Castaway Trader, and I will add links to all the videos and all the resources to description to this video. Just click to description below and you will get all the links. Today I will be talking about how the harmonic Elliott wave theory defines a trend, how we can detect a trend without wave counts, and how we can use simple moving averages available on every single trading platform in trading to find high probability winning trading setups. Finally, if you get bored during that video, you can scroll forward and you can just have a look at the real life performance of the trend following strategy in July 2020. And every single setup would be identified without the need to count waves. Before I start talking about the setups, I'll give you a small teaser. I posted 47 Coiling Setups starting 20th of June until August 1st. Average gain per setup was more than 7%. Max gain exceeded 30% and maximum loss was 9.5%. I find those results exceptional because out of 47 Coiling Setups, 37 of them delivered great gain and only 10 of them were negative. Again, all without counting waves. I would strongly recommend you to come back to my previous video, which was called Coiling Trading Setups, to get more details about the technicality of that setup. But just to refresh you, I will talk about that setup again in that video. Even on the cover of that video, you can get a basic idea of what I will be talking about. I will be talking about trading pullbacks. In every move up, in uptrending market, in a bull market, price never goes up in a straight line. It goes up and down, and here you see green labels. And actually, that chart is an actual chart which I sent to my designer, and he turned that actual chart into that beautiful cover for that video. But let's talk about the stock market and how that stock market transitions from bear market to bull market. Here you can see the actual chart of GBTC, a fund which invests in Bitcoin. And here you can clearly identify two different phases or two different conditions of the market. The first one, we see that price kept dropping down, and you see those red dots. This is where price made lower lows. No doubt that was the bear market. And you may know that it's very exciting for many traders, including myself, to try to nail the bottom in a bear market. It's very exciting because in a bear market, we always have those exciting pullbacks. Look at that. If you could nail that bottom, you could make really quick and great profit because that pullback was very strong. but look at the next bottom. The pullback was smaller. At the next bottom, the pullback was even smaller. And every single new bottom made lower lows, but pullbacks got smaller and smaller. And if you were lucky to catch that bottom, and that bottom, you felt like, you nailed the way to make money. You just wait until price makes lower low, you buy it, and you sell on a pullback. And it would work until the moment when you miss the moment when you had to sell. So now you are underwater with shares. For example, you bought it here, you saw that price would go higher, or maybe someone disturbed you and you got out of the trading desk, and now price went down. So you don't want to sell because you think that price is bottoming. So you decide to hold. And you will be holding for months, looking how price goes lower and lower. And you will not be able to sell the stock at loss because you would still think that price will soon go up. And price will go up, but months later. And with a high risk that finally, somewhere at that point or at that point, you will decide to sell it. Because you won't be able to actually resist the pain. It becomes very painful to watch every day how your stock gets cheaper and cheaper. And only then it starts to go in higher, and this is when price would keep making higher highs. This is lower lows. This is what the bear market is about. And now I want to show you that the wave theory has the very same concept. So it suggests that every downtrending market follows 5-wave down fractal. And we could identify special segments of that move down. We call them waves. Wave 1, pullback in wave 2, ABC of wave 3, the strongest part of the drop, the strongest part of the decline in every bear market, which follows by a corrective pullback of wave 4 up, and the final exhaustion push down in wave 5. Any downtrend is just a sequence of lower lows and lower highs. So we essentially are talking about the bear market, but I've just shown you that you could have a simple picture like that, or you could get more sophisticated picture when you would identify special segments, you would label them differently, you would call them waves, you would find ratios between different waves, and this is my main approach in trading. The problem is, if you are starting, if you have never ever dealt with waves, it could look like complicated for you. And this is what I heard from many friends of mine. They said like, look, you have recorded great video courses, but the problem is it still looks kind of difficult for us. We need something like simpler to start with. And this is why I came up with a different approach, and we will talk about that a bit later. But now let's start talking about the bull market. Every bull market also has different stages, but the sense of the bull market is kind of the same. This is when bulls keep making a sequence of higher highs, and you see those higher highs marked with green dots. And again, the wave theory considers the very same phenomenon of the bull market, but with kind of more sophisticated tools. With waves, we can identify wave 1, corrective wave 2, the strongest part of any rally wave 3, which itself is subdivided in 3 subwaves A, B, and C. Then we get a corrective wave 4 down, and the final push high, exhaustive push high in the final wave 5 up. The idea of that fractal, that repeating pattern, is that we have wave 1, 3, and 5, they are impulsive waves, they push price to higher highs, and we have pullbacks, temporary pullbacks when bulls are cooling down. And the main idea behind the wave theory is that if you could identify an unfolding trend up. And if you could identify the top of every impulsive wave, then you would be able to wait until a pullback, a corrective pullback, which normally is structured ABC, ABC, ABC. If you could count those microwaves, you will be able to benefit from those pullbacks. You will be able to buy those pullbacks in anticipation of the next move up, in the next impulsive move in direction of the main trend, which is up here. I explain the wave analysis in details in my 2 video courses. This one is the video course for beginners, and many people like those courses. For some people, that approach of counting waves changes the way how we trade forever, but for many other people, that approach sounds too complicated. And this is what became my goal. My goal was to simplify criteria of a trend. I needed to find a way how we could identify change in direction of the trend, the way how I could identify different stages in the process of development of the trend, and finally, and the most importantly, how we could identify the point where we could benefit from those pullbacks I've just shown to you without applying wave analysis, without need to count waves. Many people say that to get proficient in something you are doing, you need to be able to explain what you are doing in plain language to a baby. And that's probably the height that any professional could reach, when he could find a way how to get something very difficult to understand and put it down like in a very simple words and to teach that to other people. And doing that, you kind of improve your own skills. And this is my own selfish interest. You may ask why you record that video about that great setup, why you share it with us. I share it with you because when I work on those videos, when I work on the setups, I improve my own skills. The more videos I make, the better I'm getting at those setups, and in trading, the more money I'm making. Okay, again, if you want to know more about that Coiling setup, just watch my previous video, Coiling Trading Setups. I will post a link in the description and you will find it on my YouTube channel. But let me quickly recap what I was talking about in that previous video. To be able to identify trend direction and different stages of the trend, we do not need very sophisticated indicators. Actually, we only need 200-day moving average and 50-day moving average. And if we add them to the chart, they provide us with a lot of useful information. For example, here you see that 200-day moving average got flatlined, and then 50-day moving average got over it. Price went over both of them, came back down, retested them, and that was the official start of the bull market. This is where I also used wave counts, but you can see that you do not need to count waves here. You can only look at the moving average, their relative position to each other and the price, and the slope of those moving averages. Now you can see that if you could fill the distance between 50-day moving average and 200-day moving average with green color, you will see that you would be getting a band which actually would be widening. The higher price goes, the wider that margin between 50-day moving average and 200-day moving average gets. I call that margin between those two moving average the margin of safety for bulls. The wider it gets, the safer you are with your long position. And what is really interesting and very important in your trading, that you can see that in the process of that bull market, from 2016 until the middle of 2019, this is Netflix by the way, you will see that that stock would be making many pullbacks, but those pullbacks would be bought out right at the edge of that margin of safety of bulls, that white stripe that actually protected bulls. And if you could buy every single test on 50-day moving average, you could have made tons of money. Look how many times it tried to test it and how many times bulls defended that line, until that point when bears managed to move deep into the bad stripe, but then even that move down was bought out. But when such a deep pullback was made, that was a first red flag for bulls, and that was probably the start of the end of that particular bull market. And finally, you see bears violated 200-day moving average again. That was a huge bounce. Even if you bought here, you would have been able to sell it with profit at that spike, and only then bears managed to break under 200-day moving average. Adding 50-day moving average lets you check direction of the medium-term trend in comparison to the long-term trend, which is identified by 200-day moving average, and the relative position quickly shows the direction of the main trend. And here I added green and yellow arrows, which actually show potential long entries during several years of that bull market. Again, this is perfectly aligned with what wave theory tells us about the way how bull market gets unfolded. We get move up in an impulsive wave followed by a corrective move down. And the whole idea of trading the bull market is to buy pullbacks, because you know that until the bull market is over, the next push up would most likely make a new higher high. And those in wave theory, we call those temporary pullbacks corrective waves. Again, if you employ that simple approach of dealing with moving averages, you do not need to learn waves, even though I would recommend you doing that, because you would better understand what price is doing and what you could expect next. Now I will be talking about real-life setups, which I posted from late June until early August 2020. I created a private Twitter feed, which is called Coiling Setups. Up to that moment, that private Twitter feed was only available for subscribers of my premium chat. But I'm going to offer you a chance to join that private Twitter feed, and at the end of the video I will explain you how you can do that. Alternatively, you can check the description of that video and you will see the link how you can become a subscriber to that private Twitter feed, where I have been posting and I will be posting those coiling setups. So first of all, I will show you like 30-40 first setups I posted starting early June. You see the first day I started to posting them was 23rd of June. Now look how many big wins those setups delivered: 20%, 8%, 9%, 31%, 23%, 19%. The next batch of setups: 16%, 6, 7, 10, 11, 20, 50. Now compare it to those setups which did not deliver great gain: -4, -6, -0.2, very limited downside. The next batch: 21%, 8%, 8%, 8%, 14% gain, 8% gain, 8% gain. And many of them delivered that exceptional double-digit gain like in a matter of days. Why it happens? Because you trade with the trend. Again, look at the very limited number of those setups that failed. 1, 2. It does not guarantee, and nobody could guarantee, that that setup would be working forever. And you can follow me and I will be posting new updates about performance of my setups, or Alternatively, you can join my private feed and trade them with me and making money in the process, and you will see what setups are working and what setups do not work. Now I will show you several actual setups I posted. That was one of the first ones, AEM daily chart, posted on June 23rd. What I want to show you is that price. First, what we are looking for? We look for the first strong move up. This is the sign of bull strength. This is the sign of underlying bullish momentum. And then we wait until it comes back down in some ABC fashion. ABC. We don't like when price drops like a rock. We want that ABC corrective structure. This is what we learned from the wave analysis. This is kind of a valuable mix of wave analysis with those simple instruments. But if I did not practice wave analysis, I would never be able to come up with such a simplified method of identifying winning long setups. Look at MACD. It's called a coil. It goes up strongly over the zero line and then it comes back in some kind of controllable way, and the point when it gets to the zero line, that makes the price interesting. That is the point when pullback could find support, and this is what we are looking for. We are looking for a confluence of Coiling Setup in MACD with the point when ABC pullback down would find support at 50-day moving average. And this is how that setup worked out. It delivered 21.5% from June 23rd until July 31st. And the idea behind that setup again is that the residual bullish momentum, is so strong that that kind of limited pullback down does not kill that momentum. Momentum is still alive. The momentum is strong, but the stock is not longer overbought. It's a cool down stage when it's kind of a bear trap. You could say a bear trap. Bears are going back down here. So here bears are so scared they would probably drop all the shorts. But at the point when price makes that ABC down, we start to believe that probably the top is in. But the fact is the underlying momentum is still strong, and at the moment that the green support channel gets defended by bulls, more and more bulls are coming back to that market. And this is what you will see on all of my charts. You will see that the channel, green channel, I call it demand channel. You see how many times you could have bought that stock after it tested the channel. 1, 2, 3, 4, and 5. And look at the final resolution of that setup. Just amazing. The next one, SFM. I posted it on June 24th. The very same story. And you will be amazed that all the setups I'm showing you would look almost the same. They would look almost identical. And I would explain later why it happens like that. Look, very strong move up. It's an indication of underlying momentum, and the very same pullback, ABC. I always look for that ABC because if it was a strong drop down, I would not touch that stock. That ABC, it's a sign of a corrective pullback under the wave theory. And look where it found support, right at 50-day moving average. And look at MACD, the very same Coiling Setup, strong move up over the zero line and controllable decline towards the zero line. And this is once it crosses under the zero line, this is when that stock becomes interesting if simultaneously it's testing one of the major moving averages. How it worked out? It worked out great. It delivered 12% as of July 31st. Again, that simple method would provide you with two potential entries. First test of the green demand channel here, and first push up, you could sell it here at the retest of the previous high. You wait for another ABC, A down, B up, and C down, right into the green demand channel. Look at that long tail that shows demand from bulls, and look how it reacted afterwards. another setup, ABT daily, posted on June 30. Very same story, guys. Coiled MACD. Now you know how it looks like, and look at that bullish flag. And you will see those bullish flags on my Coiling Setups many times. You see very strong push higher. And then bears, yes, they managed to turn it down, but we could not produce such a strong move down. It's like, whipsaw, ABC down, X ABC down, another X ABC down. So it's kind of a complex corrective structure. But what really matters is that bullish flag is easily identifiable by so many traders. That flag becomes magnet for bulls. And when price starts to going down after retest of the 50-day moving average, and when MACD is coiled, that it's the time to go long. This is what happened, and this is a typical resolution of a coiling setup. Very strong resolution, very strong breakout of the bullish flag. It delivered 9.3% since June 23. STMP. Guys, very same story. Another bullish flag into 50-day moving average, another coiled MACD, another amazing rally. Actually, that was the best setup I had over the previous 30 days. It delivered 31% as of August 3rd. And again, that green demand channel provided you with two opportunities to go long. Two tests, and both tests bears failed. And CCC, coiled MACD, bullish flag, test of 50-day moving average, boom, resolution, 15.7% gain since July 1st. It's a great result, guys. AZN. This is where I show you not only coiled MACD, not only 50-day moving average, but I try to teach my followers basics of the wave analysis. And basically, a coil is a wave 4, a corrective wave 4, which precedes the final exhaustive push high in wave 5. And the great about that setup is that wave 5 should normally make a new high over the previous top, over the top of the first strong move up, which we count as wave 3. That was a bullish flag, and in wave theory, bullish flag is often called a triangle because it is composed of 5 subwaves, A, B, C, D, E. Together it's wave 4, corrective wave, consolidation. Look, after such a strong move up, bears managed to retrace only 41.4% of that strong move up. That's an indication of the underlying bullish momentum. This is why we are going long. This is what happened after that. Look, from 23.3, this is when I posted that setup somewhere here, it spiked to $65. Yes, it dropped afterwards, but even after the drop, it's still 15.7% over the entry price. ENTG. Again, a classic look, very strong underlying bullish momentum and somewhat like whipsawish kind of pullback into 50-day moving average coincided with coiled MACD. And again, we look at the retracement, we look how strong was that move up, and the following move down retraced only 1/3 of the rally. Again, it's a great sign that something is brewing up there. Look what happened. It's crazy. It delivered 21.4% since July 15th. Great story. And look how that green demand channel actually kept every single attempt of bears to break down. And look how the 200-day moving average is sloped upward. It shows you the real direction of the long-term trend, which is up. This is what means to trade with the trend. You want to see two things. Mid-term trend direction is up, which is indicated by the green channel, and long-term trend direction is up, which is indicated by the magenta trend line. So, in conclusion, I cannot post all the 47 coiling setups, but the first results are really impressive. Again, I cannot guarantee, nobody can guarantee that setup would work forever, but I think the first results are great and I would strongly recommend you to give it a try. Now, I have a great offer for you. So you can start 15-day free trial of my private Twitter feed, where every day I post several coiling setups. And that's not all. There is a bonus. If you subscribe to that private Twitter feed, you would get a bonus, a proprietary indicator I coded for TradingView. So you would not pay a penny for that indicator, and that indicator is currently available only for subscribers of my premium chart. So if you subscribe to that private Twitter feed, you would be able to get access to that proprietary indicator, which is invite only. You see that log? Other people cannot get that indicator. For example, this is Moderna, that crazy like biotechnology stock, which was rumored to start like making that anti-COVID vaccine. Look how many entries you could get. So that indicator would not only draw the trend lines, it would show you where you could consider buying that. That would show you buy alerts. And not only that, that indicator would let you set email alerts. So you would be able to set email alerts which would go directly to your own email, and you would not need to wait for me to post trading signals for you. This is what could actually make trading easier and which could deliver more high probability winning trading setups without the need of learning and practicing complicated wave analysis. Thank you for your time. Please subscribe to my YouTube channel. That means a lot to me, believe me. And finally, I would really appreciate if you like this video, because that would encourage me to record more videos and maybe to code some new great indicators. Thank you for your time and good luck with your trading.